If you own a home, I need you to listen like your equity depends on it, because for millions of people, it does. Here's the claim that sounds insane right up until you do the math. The next wave of homeowner wipeouts won't start with a crash. It will start with normal bills, an escrow notice, an insurance renewal, a tax reassessment, a job disruption that lasts 60 days instead of 30. And then, quietly, families will be forced to sell at the exact moment the market gives them the worst price. This isn't random. It's not bad luck. It's not the market being the market. It's the predictable output of a machine that runs in stages. Authority check before you dismiss this. Global debt is still above 235% of world GDP, and in dollar terms, it's around $251 trillion. In the US, today's mortgage balances alone were about $13, or $7 trillion at the end of Q3 2025. And as of January 22nd, 2026, the average 30-year fixed mortgage rate was about 6.09%. Now, let me explain why that matters in the simplest way possible. A leveraged asset doesn't have to crash for you to lose everything. You lose when you're forced to act, forced to refinance, forced to repair, forced to move, forced to sell. While financing is expensive and buyers are fragile. And the 40 million number, that scale is real. The Mortgage Bankers Association's National Delinquency Survey is built on a sample of almost 40 million first-line loans reported by servicers. That's the homeowner class that is still attached to a monthly payment system, still plugged into interest rates, escrow, insurance requirements, taxes, and the job market, still vulnerable to the machine. So here's the promise of this video. In a few minutes, you'll be able to spot the 4 stages of this machine like a doctor reads a chart. Because once you see the pattern, you stop arguing with opinions and start respecting inevitability. But first, I want you to do something that instantly raises your retention of this message. Picture your monthly payment, not just principal and interest, your full payment. Now ask yourself a question most people never ask until it's too late. If your insurance jumps 30% at renewal, do you have room? If your property taxes rise because assessments catch up, do you have room? If a roof, HVAC, or foundation issue shows up, do you have room? If your household income drops for 90 days, do you have room? Because the next housing event won't be announced, it will be felt. Now the machine, 4 stages, simple, brutal, repeatable. Stage 1 is the setup, rules loosen, money gets easier. Risk is disguised. The public is told this is stability, recovery, access, ownership. But the real effect is this. More credit can chase the same assets. Stage 2 is expansion. Prices rise because credit rises. The market stops measuring value and starts measuring monthly payment. People don't ask, is this house worth it? They ask, can I make the payment? That's the moment a society quietly shifts from ownership culture to debt culture. Stage 3 is the squeeze. Rates rise, or costs rise, or jobs soften, or all 3. The system doesn't collapse immediately. It tightens. It tests the margin of every household. Stage 4 is transfer. Homes move from weak hands to strong hands. That transfer can be loud, foreclosures, or silent. Forced sales, investor buyouts, negative equity traps, insurance non-renewals, tax delinquencies. Either way, the same result, concentrated ownership. Now I'm going to prove this mechanism in history quickly, but in a way that actually matters. Not history class, pattern proof. First proof, the US housing bubble into 2008. Setup, cheap money after early 2000s shocks and a rapidly expanding securitization machine. Mortgages could be originated and sold, which meant the incentive was volume, not quality. Risk was sliced, stamped, and shipped. Expansion, underwriting loosened. Adjustable rates and teaser structures made payments look smaller than reality. Home equity became spendable. Prices rose faster than incomes because credit filled the gap. The narrative became a weapon. Real estate always goes up. Squeeze. Rates reset, defaults rose at the edges, then confidence snapped in the credit markets. This is the key lesson. The housing system didn't just fail because people missed payments. It failed because the financing structure depended on everyone believing refinancing would always be available. Transfer, foreclosures, forced sales, and then institutional accumulation of homes as rentals. Neighborhoods flipped from owners to tenants. The machine completed its cycle. Second proof, Japan's asset bubble and long stagnation. Setup, policy choices that fueled credit growth and speculative confidence in land values. Expansion, land and asset prices climbed so aggressively they became part of national identity. Lending became circular. Collateral rose because prices rose because lending rose. Squeeze, tightening and repricing. But Japan shows something Americans often miss. Your loss doesn't need a dramatic crash. A decade of debt equity can erase a lifetime plan. Transfer, consolidation, impaired households, and an economy living under the weight of balance sheet repair. Different shape, same outcome, household wealth expectations collapse. Third proof, Ireland's boom and bust in the euro era. Setup, cheap capital flows and low rates. Expansion, property and construction became the engine. Debt piled up fast. Squeeze, funding markets froze, banks broke, and the state had to stabilize the system. Transfer, households were left with debts that outlived the boom, and the social cost was paid in years of lost opportunity. Again, transfer, sometimes of property, always of time. Now we apply the same machine to the present, and this is where you need to stay with me, because this is the part most people get wrong. The setup phase is already done. The 2010s and early 2020s trained the entire population to think in one unit of measurement, monthly payment. Years of low rates made expensive homes feel affordable. Then pandemic-era conditions poured fuel on scarcity and asset inflation. Check. The expansion phase is also done, but it disguised itself as safety. Right now, a huge share of homeowners are locked into low mortgage rates. That sounds like protection, until you understand what it actually creates, a frozen market. Owners don't move. Inventory stays tight. Prices stay supported. Everyone thinks the system is stable because the surface doesn't move, but stability created by lock-in is not stability, it's rigidity, verified. Now the squeeze phase, this is where 2026 becomes dangerous. Most people think, my rate is fixed, I'm safe. But your cost of ownership is not fixed. Your taxes can rise, your insurance can rise, your repairs can rise, your HOA can rise, and your income is the most variable part of all. Meanwhile, the cost of money for anyone who has to borrow now is much higher than it was. As of January 22nd, 2026, the 30-year fixed rate was about 6.09%. That's not just a number, it's a gate. It separates people who can buy your home from people who can't. And now I'm going to reveal the silent killer most homeowners don't factor in until the month it hits. Escrow shock. Even with a fixed mortgage rate, your payment can jump because your lender recalculates escrow based on higher taxes and higher insurance. You don't get to negotiate with an escrow recalculation. You either pay it, or you enter the zone where late fees, delinquency, and forced decisions begin. Now layer in insurance reality. In parts of the country, especially higher risk areas, home insurance availability and pricing are tightening. In California, for example, researchers have documented rapid premium increases and market stress, including large approved rate hikes for major insurers. And nationally, S&P Global Market Intelligence's Rate Watch has reported double-digit homeowners. Insurance premium increases across multiple years, pointing to a broad pressure trend. Here's why that matters. Your mortgage requires insurance. If you can't obtain or maintain it, the system has ways to force coverage, often at a higher cost, or to push you toward default conditions. So the squeeze is not just rates, it's the entire cost structure of staying in the home. Undeniable. Now the transfer phase, the part nobody wants to imagine, because it feels personal. But this is structural. Transfer begins when enough households become forced sellers. You can see early signals. The MBA reported mortgage delinquencies increased in Q3 2025, and foreclosure starts rose, with about 20% of loans entering foreclosure that quarter. These aren't 2008 numbers, they are early cycle numbers. The first cracks, the before picture. The transfer accelerates through 3 channels. First, forced sales. If your payment rises or your income drops and you don't have liquidity, you sell. Not when you want to, when you have to. Forced sellers don't negotiate, they accept. Second, equity evaporation. If home prices flatten or fall in your area while ownership costs rise, your equity can shrink faster than you expect. And because housing is illiquid, you don't feel it daily. You discover it when you need to move, refinance, or sell, when it's too late to adjust smoothly. Third, institutional capture. Distress creates discounts. Discounts attract capital. Capital buys quietly at scale. Over time, ownership shifts. Now I want to do something that increases engagement instantly. I want you to pick which group you're in, because the machine treats each group differently. Group 1, you bought before rates rose and you have a low fixed rate. Your main risk is not interest. Your main risk is the squeeze, taxes, insurance, repairs, job disruption, and the trap of not being able to move because replacing your mortgage is too expensive. Group 2, you bought recently at higher rates. Your risk is double, your payment is already elevated, and refinancing isn't guaranteed. You are more sensitive to job loss and cost spikes. Group 3, you're trying to buy. Your risk is entering at a time when affordability is fragile and the market can shift regionally fast. You need to avoid becoming the new buyer at the wrong price in the wrong zip code. Now here's the part that makes this feel mathematically inevitable. A housing system is only stable when household margins are stable. Margins are the space between your income and your fixed obligations. When that space shrinks, one surprise turns into a chain reaction. And in a debt-saturated world, remember, global debt is still above 235% of world GDP, policymakers can't painlessly fix everything. If they cut rates aggressively, inflation risk rises and asset speculation returns. If they keep rates higher, the squeeze tightens. Either way, someone absorbs the cost. That's why the story "this time is different" keeps failing. It's not about morality. It's not about what people deserve. It's about constraints. So when you hear 40 million homeowners could lose everything, don't imagine 40 million foreclosures in the street. Imagine 40 million households attached to the system through a first land payment structure, living inside a cost environment that can change faster than their income can adjust. And the moment they become forced decision makers, the machine does what it always does: transfer. Now let's turn urgency into something useful. Here are practical moves that reduce your exposure to the squeeze without panic or drama. Know your real payment risk. Pull your last escrow statement and your insurance renewal. If your insurance rose last renewal, assume it can rise again. If your taxes rose, assume assessments can continue to adjust. Build liquidity like your mobility depends on it, because it does. Liquidity is not extra. It's time. It's the ability to survive a 60 to 90-day disruption without becoming forced. Stop treating equity like cash until you understand the cycle you're in. In the expansion phase, equity extraction feels smart. In the squeeze phase, it can be fatal because it removes your buffer. Map your local risk. Housing doesn't crash nationally the same way. It breaks locally first, where insurance is stressed, where employment is concentrated, where investor ownership is high, where prices ran up the fastest. If your market is one of those, you don't get the luxury of waiting for national headlines. And if you're shopping, don't buy a payment you can barely afford, assuming rates will save you later. Rates might dip briefly in 2026, but timing the market is not a strategy, it's a prayer. Now, the final warning. Listen carefully. This won't feel like a movie. It will feel like paperwork. It will feel like bills. It will feel like, why is my payment higher? It will feel like, we'll catch up next month. It will feel like, we'll refinance later. And then 1 month becomes 3. 3 becomes 6. And the machine takes over. The machine doesn't need you to fail dramatically. It only needs you to lose your margin. And once you lose your margin, you lose your choices. And when you lose your choices, you lose your wealth. Quietly, quickly, and permanently. So don't argue with the pattern. Use it. If you want the next step, subscribe, because the next video is where we map the transfer phase in detail. Who buys the distressed inventory, how neighborhoods flip from owners to renters, and what signals show up months before the headlines do. Watch the next episode if you want to understand how the machine was built and how to survive the next stage before it becomes your reality.